The stock market had a rough week this week, and there's a number of reasons for that, but one is the selling off of a lot of high value stocks where a lot of growth was really priced in. When you get interest rates rising like they did this week, that can make investors really think about, am I really paying the right price for these stocks? So today I want to highlight one value stock that's trading for a very reasonable price to earnings multiple, and I think has durable cash flow in the business, and that company is Crocs. Crocs is the company that makes those rubber shoes that you've probably seen all over the place. It's a much stickier business than I thought it would have been a decade ago. And it's one that I added in 2023 because I love the trajectory and the way that management is operating this company. So I want to dig through some of the key metrics to look at today and why I like this as a value play. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's first look at some of the high-level metrics for Crocs. The first thing I'm going to show here is the revenue trajectory for the company over more than a decade. And you can see that there's been a ton of growth over the last few years. One of the growth drivers there was the Hey Dude brand, the acquisition that the company made. But actually the core product, the core Crocs product, has grown tremendously as well. But the thing to highlight here is really the split between wholesale and direct to consumer. What Crocs has done a really good job of is having a balanced business, basically 50-50 selling products into wholesale, and then 50-50, and then 50% selling to e-commerce channels or through their own stores. You can see in this chart that the two brands that Crocs has, obviously the Crocs brand, but also the Hey Dude brand, aren't really even. The Crocs brand has driven a vast majority of the growth since 2020. Going from $1.4 billion in revenue to $3 billion in revenue, and is about 3/4 of the business. So that's still the main growth driver for the company, and I think it will be for the foreseeable future. And the final thing I want to put up here starts to get to the stability of the business, the profitability. You can see the orange line is the operating margins for Crocs. You can see that that's hovered right around 25 to 30% over the last 3 years. So they've really improved that margin profile. Gross margins have also increased, so becoming much more efficient as a business. And then look at that valuation number. Price to earnings multiple right now is 9.5. And it's got a pretty similar price to earnings multiple on a forward basis, 9.7. So investors are expecting earnings in 2024 to be about flat with what they were in 2023. So what we have with Crocs is really a company with two brands that are performing pretty well in the market, and investors are getting a pretty good value. There's really not a lot more to it, but I want to dig into some of the trends that we saw in the recent fourth quarter numbers and get an idea of what we should expect for 2024, because at the end of the day, it's not past results that's going to drive the stock price. It's going to be future results. So if a company like this can grow revenue at 3, 4, 5% and grow cash flow, increase those operating margins a little bit, either buy back stock or return money to shareholders through something like a dividend or a special dividend, that's where you're going to get a lot of return for shareholders. So let's dig into those numbers as well. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. These are the highlights for all of 2023. You can see that revenue was up 12% last year, and that was driven by the Crocs brand, up 14%. Hey Dude went through some strategic changes which impacted the company's revenue. I'll get to what they're expecting for 2024 in just a second, but they were very profitable and paid down $666 million worth of debt and then repurchased $175 million worth of shares at an average price of $105 per share. Shares are trading at $120 per share as I'm recording, so looks like that was a pretty good use of capital. But I like to see the fact that they're reducing debt at the same time. You want to take that leverage and that risk out of the business as well. I've highlighted some of these numbers already. Crocs is about 3/4 of the business, and the channel is about 50-50 direct to consumer and wholesale. The other thing to keep in mind on is there's still a lot of opportunity for growth in international markets, in particular parts of Asia where Crocs is starting to see a little bit more momentum. Now, I mentioned the drop in revenue for Hey Dude, and one of the things that Crocs was doing was reducing the number of distribution partners and retailers that they were working with Hey Dude specifically. And one of the things I think we saw was Hey Dude expanded really quickly. That looks great, but eventually if you have to start discounting your products, now you start looking like a cheap brand from a retail perspective. And you really lose control of the business if you're a company like Crocs, if you have too many distributors and too many retailers. So that's what I think we're seeing, is a pullback on the number of retail outlets and distributors that they're working with. The other great thing from an investor perspective, and this goes to the pricing and the Hey Dude distribution change that I talked about just a second ago, is the inventory balance was down 18% year over year, 472 million down to 385 million. Inventory is a massive challenge for product companies because you have to make the right product and the right amount of those products in the right SKUs, in this case, the right sizes, and get those to retail. It's a really challenging logistics problem for a lot of these companies. So oftentimes you can look at inventory and inventory turns, which is going to be revenue divided by inventory, as a health of both the company and also management's operations of the business. So really good sign to see revenue growing and inventory on the decline. They're also targeting net leverage ratio to be a little bit lower than it is today, which again, I see as a positive sign because leverage can be positive for a business, but you don't want to have so much debt that it's really a hindrance. And that's what it was at 2.1 times EBITDA after the Hey Dude acquisition. But let's get to guidance. And I think this, again, shows the trend that we're going to see throughout the year. So the first quarter and kind of the first half of the year, you're going to see results be a little bit down probably. And that's largely because of the Hey Dude brand and the wholesale and the distribution changes that I talked about earlier. So that's having a negative impact on the amount of product that's going into the channel, even if the same amount of sales are happening coming out of the channel to end markets or end consumers. But growth on the Crocs side expected to be really strong at 6 to 8%. So the core business, the bigger piece of the business, is doing well. They're kind of reconfiguring the Hey Dude side of the business. For the full year, though, you get to growth of 3 to 5%. Now, again, if a stock is trading at 9.5 times earnings and growing 5% a year, that's a pretty good value stock. And that's, I think, exactly what we're seeing with Crocs. And this number is probably a little bit lower than what you would expect overall because of this negative impact of Hey Dude early in the year. So here's where you get that earnings per share, $12.05 to $12.50. Really reasonable multiple. And I think if Crocs is generating the kind of cash that you would expect, they're going to either buy back some debt or buy back stocks, depending on what shares do over the next year or so. So you add all of this up, and I think Crocs is just really well positioned in the market. It has the right product at the right price point and the right margins for potentially an economy that's going to slow down a little bit. Maybe people aren't going to be spending as much on $100, $200 pairs of shoes, but are you going to put off buying a pair of Crocs? I don't think that's the kind of thing that people are going to put off. And especially as we're spending less time at the office, it makes products that Crocs is making. It makes the kind of products that Crocs is making more attractive to a lot of buyers. So see a lot of opportunity for them to keep consistently growing that business a little bit over time. You don't have to grow at a massive rate when you're trading at this kind of multiple and still be a great value stock. So I love the stickiness of the business and the price that we're paying as investors. This is why I finally bought shares in 2023, and I'm happy that I did, happy to hold them and let this steady growth story play out over 2024. Again, I think we're going to see a ramp up in growth towards the end of the year as that Hey Dude transition rolls over to a new year. But what do you think about Crocs stock? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.